This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest monthly bonus podcast from the AJ Bell Money Markets team, all about investment trusts. I'm Dan Coatsworth, and joining me is Laith Khalaf. Hi there, Laith.
Yeah, hi Dan. We've got some really interesting interviews on this edition of the podcast, including an expert from Polar Capital Global Financials Trust, who's here to explain why banking shares have enjoyed such a strong run.
Emma Bird from Winterflood will be joining us to explain the world of gearing, what the term means and how it can be a help or a hindrance to performance for investment trusts.
And I'll be talking to one of the managers of the Henderson Smaller Companies Trust about the impact of changes from last October's budget on UK businesses, which are just coming into force.
Now, we've also got the team from Shares Magazine going to do a deep dive on the BlackRock World Mining Trust. But first, let's start with a bit of news. So, Laith, I saw the Association of Investment Companies has just put out some interesting research, kind of lifts the lid on exactly who owns investment trusts. So, what's it been saying?
Yeah, it was quite interesting. And they've basically split investment trusts into, as you say, looking at who owns them, and they've split them into largely, give or take, three groups. One is private individuals, private investors. One is wealth managers. So those are people at Rathbones, Cazenove, some of the banks. They're departments who deal with high net worth clients. They run portfolios for them. It's called wealth management. And then there's institutions, and that includes pension funds and asset managers. So I think, Dan, this is probably a good opportunity for a pop quiz. I don't know if you've recovered from the ISA quiz on the Money Markets podcast the other week, but I remember you came second. So just you in this in this pop quiz. So you've got a very good chance of coming first, I'd say. But can you looking at those three sort of different owners, so private individuals, institutions, and wealth managers, how do you think it's split? And the reason I'm asking this is partly to be facetious, but also because I was quite surprised by the numbers.
I reckon maybe half for wealth managers, a quarter for institutions, and a quarter for sort of the everyday members of the public.
Yeah, that's what I was thinking. But actually, it's skewed a bit of a different way. Actually, institutions own almost half of all investment trusts, so pension funds and asset managers. I was quite surprised by that. They're at 48%. Wealth managers at 24%. And private investors at 26%. So we often think about investment trusts as a world that's kind of dominated by private investors and probably those wealth managers, but actually there's a lot of institutions, pension funds and asset managers who hold it as well. And I was thinking why this might be the case, and I wondered if passive investments might have something to do with it, because there's a lot of money going into passive funds, and that's particularly the case in the pension space. And a passive fund investing in a FTSE All Share has to invest in investment trusts, right? Because they're in the FTSE All Shares. So I wondered if that might have something to do with it. But it's quite an interesting split between those three groups. And it's actually, the data also kind of lifts the lid on the amount that are held in various bits of the investment trust world by private investors. So overall, private investors hold 26%, but there are some bits of the investment trust world where they are really concentrated holders. And again, this probably might speak to why you and I thought that they would be bigger shareholders, Dan. But they hold 26% of all investment companies overall, but 37% if you look just at the equity trusts. And it's actually much more concentrated within certain sectors. So it's up to 55% of UK equity income investment trusts. So a lot of income seekers out there, partly perhaps to do with the fact that investment trusts can hold back dividends to pay out a more regular income stream, which probably makes them popular. Also, global and global smaller companies and global equity income, popular sectors with particularly retail investors. They're up to 50% of those particular sectors. And, again, overall, looking at the whole pie, UK investors hold 74% of investment trusts, with the remainder being held by overseas investors. US investors holding 13%. I don't know, Dan, if you can think of any recent US investors that might be on that list.
Well, maybe one that starts with S
Maybe
and it
one
ends with Arbor.
that's yes, that struck me that they might be on there. And again, perhaps some more trackers from across the ponds as well, who've looked across and got some of the investment trusts over here because they're tracking the FTSE All Share, right? So I think this is all interesting because in the context of that US investor Saba, we've been talking about how vulnerable investment trusts are to activist investors, potentially because they have got a diverse shareholder base of retail investors who are perhaps a bit more difficult to mobilize. But I saw these figures and I actually thought that's it's not quite as diverse as I thought it was. Obviously, there are some sectors there that are just run through where actually there are quite a high level of retail shareholder participation. And as we saw with Saba, even though there were a large number of retail investors on the books of the trusts that they were looking at, there was actually a very high turnout for the vote, which I think shows that if something is really important, such as what Saba was proposing, that people are willing to come out to vote. Perhaps they don't vote in the more run-of-the-mill, we're appointing a new member of the remuneration committee type proposals. But when actually the trust strategy is on the line, I think those votes did show that retail shareholders are tuned in and willing to come out and vote.
Oh, brilliant. Well, Laith, that's very interesting stuff. So should we bring on our first guest now? Because obviously at the start of the podcast, we promised you quite a few experts on the show this issue. So I think listeners, you're going to really like this one.
Yeah, well, it's about banks. What's not to like? So many people, of course, hold UK banking shares for generous dividends, but the financial sector is actually is interesting on a broader geographical basis, and US banks in particular. They enjoyed a strong run when Donald Trump won last year's presidential election. And to explain why that happened, we thought it would be good to chat with Nick Brind from Polar Capital Global Financials Trust, as he's been keeping a close eye on the sector. Dan recently caught up with Nick, and this is what he had to say.
Well, I'm pleased to be joined by Nick Brind from Polar Capital Global Financial Trust. So, Nick, thanks ever so much for coming on the podcast. I think maybe we'll start off the conversation by just saying, can you just give a quick overview exactly what the trust is trying to do, and perhaps where in the world that you find your investment opportunities?
Yeah, absolutely, and many thanks, Dan, for having me on. So the Polar Capital Global Financials Trust, as the name suggests, it gives you a broad exposure to global financials. So you get exposure to really well-known banks, whether that's JP Morgan in the US, UniCredit, Italian bank, or sort of ICICI Bank in India, consumer lenders like American Express, the great Berkshire Hathaway, Warren Buffett fame. Some asset management businesses that could include BlackRock, Blackstone, Ares Management, or something like an ICG closer to home. Stock exchanges. We own NASDAQ. We own some Deutsche Börse in Germany. Insurance, so exposure to Lloyd's of London as well. So we own Beazley as an example. So it's giving you that broad spectrum to the sector.
Okay, so when Donald Trump got back into the White House recently, there was sort of quite excitement around US banks in particular, hope of looser regulation. We saw quite a lot of banks rally, and actually, even your investment trust share price was deemed to be one of sort of the potential beneficiaries. What's actually happened since he's returned to the White House? Is it still just talk about potential loose regulation, or has something actually changed the system?
Yes, no, I mean, there is change happening. It doesn't happen overnight. I mean, what he did last time, so in Trump 1.0, he changed the heads of the different regulatory agencies. They set the tone of those individual agencies and make, changes consequently on the back of that. And you're seeing the same narrative this time. At some point over the next 6 to 12 months, what it probably means is a lighter regulatory touch. That probably means slightly less costs certainly for the banking sector, potentially therefore capital return, easier to do M&A activity, and therefore that's good for investment banking fees for those companies obviously want to merge, etc. And that's definitely going to be a positive tailwind for the sector. In the short term, obviously, there's concerns about trade tariffs, etc., and perhaps some soft economic data in the US. But fundamentally, we see it as positive.
Yeah, I mean, it's not just in America that the banking sector sort of enjoyed a bit of a run on the stock market. UK and European banks also had a pretty strong run over the sort of maybe the last year. What's sort of been driving those stocks upwards?
Yeah, so one of the big drivers of the sector in recent years is this called the normalization of interest rates. So interest rates going back to a level that used to see, pre-GFC. Consequently, the profitability of banks and insurance companies are a lot better with higher interest rates. They make, in the case of banks, they make more money. The difference between what they charge on mortgages and loans versus what they pay out on deposits. For insurance companies, it's similar. The float that they have to pay claims is invested in cash and bonds for the most part. So they're earning more on that cash and bonds. In the case of UK and European banks, therefore, as interest rates have gone up, their margins have expanded. So they're all making more money and higher profits. And on the back of that, share prices have rallied strongly. The other interesting fact is, when you consider what's happened in the last 5 years, we've had a 1 in 100-year pandemic, a huge increase in inflation up to 10% plus, interest rates up by 5 percentage points, unemployment spiked up to 10% in some countries, and yet you've seen very little deterioration in asset quality, so bad debts. You haven't seen a big spike in bad debts, which is always the why if you're in a bank stock. So, against that background, European, UK bank shares have done extremely well.
I mean, if interest rates start to come, they are coming down now. Is that not a negative then for banks in terms of their earnings?
No, it's a really good point. Interest rates going up is obviously good news. Therefore, interest rates going down must be bad news. It's a little bit more nuanced than that. The issue is for banks, when interest rates fell to effectively 0% or is negative in the Eurozone, it's very difficult for banks to make any, much money at all. Those first few interest rate increases is where banks started to make a lot more money. So they make more money on those first few interest rates increases. So if you don't believe interest rates are going to fall below, let's say 1%, maybe a little bit higher than that, then they're going to maintain a lot of that improved profitability, because as interest rates have gone up, they become less sensitive to those moves. The other thing that's happened with interest rates having stayed a little bit higher than everybody expected is given banks the chance to hedge some of that risk, take out interest rate swaps. So they're not so sensitive to falling interest rates in the shorter term. So that combination of less sensitivity in the shorter run, plus rates having stayed higher, and actually you need rates to fall, materially further for them to be impacted, has meant actually share prices have continued to perform better than people expected.
I think a lot of people are attracted to financial sector, whether that's banks or life insurance companies, for the dividends. I mean,
Yes.
In terms of your investment trust, are you primarily looking for capital growth, or would you say you're also a sort of a solid income play as well?
So it is an income and growth mandate. The yield today is around 2.5%, 2.6%. Some proposals have been put forward by the board to increase the dividend to 4% on the NAV. So 1% a quarter, starting at the end of the company's financial year end. So that's November this year. So that's subject to shareholder approval coming up at an AGM. Assuming that goes ahead, then that's a significant increase in dividend.
When you look for investment opportunities, I mean, the choice available around the world in terms of financial sector is pretty big. How do you decide which ones to invest in and which ones, perhaps are not suitable for the type of things that you're looking for?
Yeah, it's a great question. In some ways, we're spoilt for choice because there's some just fantastic companies in the sector. For us, we've had a quality bias. We like companies that's with strong balance sheets, good profitability. If they're a bank, they have very strong deposit franchise, or if they're an insurance company, they're a good underwriter of risk. Perhaps they're not growing too fast, taking too much risk. And then it's a case of, well, how's the valuation compare with what we think that business can do over time, and trying to balance up that risk reward between companies we want to own, but not paying too much for that.
Okay. And then the other thing I really wanted to sort of just get a sense of was, we're in sort of a sort of strange sort of situation at the moment with the talk of potential global trade war again. Lots of sort of downgrades to near-term economic forecasts. It feels like it's a lot of headwinds that could sort of see financial companies, particularly banks, not perhaps do as well as some people might have thought, say 6-12 months ago. How do you deal with that sort of near-term headwind in your portfolios? You just have to be prepared to have some cash aside, ready to buy more if things get cheaper.
Yeah, it's a mixture. I think one thing that perhaps is less well understood about what's changed in the last 10 or 15 years for the sector is, first, it's that point I made earlier. Because banks have taken less risk than they were certainly in the run-up to the global financial crisis. They've also, their balance sheets are much stronger. They've got much more liquidity. In a downturn, all things being equal, they should take less loan losses. So becoming less cyclical at the margins. So that's certainly one positive. The other is there's a lot of companies within the universe that aren't that economically sensitive. So the payment companies, MasterCard and Visa. If we take some of the insurance companies in the sector, they're not driven by the economic cycle. They're driven by weather-related losses or accidents, claims. So again, they tend to be quite defensive. So when we construct the portfolio, we're trying to be conscious of those cyclical or more defensive elements within it when we're thinking about risk. So at the moment, we've taken the back end of last year, we took a little bit of risk off the table when we saw some share prices that run a little bit too fast. But it's the nature of the beast that you have to wear some volatility in the short term. But long term, if you believe in the businesses you're buying, then we expect them to deliver good shareholder returns to investors.
Well, Nick Brind from Polar Capital Global Financial Trust, thank you ever so much for coming on the podcast. It's been brilliant to talk to you.
Thank you very much.
That was Nick Brind from Polar Capital Global Financial Trust. Right, let's move on to our regular deep dive into trusts picked by listeners to this podcast. This week, we're going to look at BlackRock World Mining Trust, and who better to discuss that than Tom Sieber and Martin Gamble from Shares Magazine.
Today, we're discussing BlackRock World Mining, which is by a distance the largest UK-listed investment trust, which puts its money at work in the mining sector. So after a period of several years where miners have been focused on paying out generous dividends to shareholders, in part to compensate them for the volatility that we've seen in commodity prices, there's been a bit of a kind of a shift more recently. It's been a difficult time for the industry. Miners have been cutting their dividends, and demand for metals has been affected by a stagnating Chinese economy, and that has kept a lid on the trust share price. Now, it's not a completely negative picture. On the flip side, some commodities like gold and copper are trading at or around record highs, and longer term metals and minerals and the companies which dig them out of the ground are seen as having a significant role as the world transitions out of fossil fuels. So giving all of these moving parts, it feels like an opportune time to discuss this trust and its prospects.
So Tom, what's actually in the trust?
So it mainly invests in large cap global mining companies and names which will be familiar to anyone with even a passing knowledge of this sector. So you've got the likes of BHP, Rio Tinto, Anglo American and Glencore, which account for nearly a quarter of the portfolio on their own. In total, you've got around 60 individual investments, and the top 10 has a weighting of more than 50%. So to sort of use the terminology of the kind of fund management industry, that's a pretty concentrated portfolio, really. It mainly invests in quoted companies, but it does have a remit which allows it to hold unquoted companies, some royalty contracts derived from metals production, physical metals themselves, and derivatives contracts. As of the end of February 2025, so we're recording this at the end of March, but the figures for that month aren't out yet. Around 30% of the trust was in diversified mining firms. Then you had about 27% in gold miners and 22% in the copper space.
Okay, so it's pretty broadly diversified, apart from the fact it's got 60 holdings, but it plays across the whole spectrum of metals.
It does, yeah, it does look
got it.
to
So
sort of play different metals.
including some exposure to non-quoteds.
Yes.
So how's it performed?
It's a kind of a long answer to a short question, I suppose. In the short term, the performance hasn't really been anything to write home about. So the 1 year total return, so that includes capital gains and dividends, is just 3.4% according to Morningstar data. And actually on a 3 year annualized basis, it's negative. So it's minus 7.4%. So, it's been struggling really more recently. And I think, we talked about China at the start. That has been difficult for the mining sector because China is such a heavy consumer of commodities, and because the economy has struggled coming out of the pandemic, that's had implications for demand. But if we broaden things out a little bit, on a 5 and 10 year view, the annualized total return runs into double digits. So I think that maybe also reflects the fact that, partly as a result of investing in a sector which can be quite volatile, there is volatility in performance, but over the longer term, it has done reasonably well.
Okay. So how have they done it? Who are the managers? What kind of investment process, or how do they go about choosing their investments?
Sure. Yeah. I mean, one thing I'd say also on performance is they have performed better than the benchmark generally as well. So, absolute performance is what counts for investors really, but in relative terms, they've done reasonably well. And that's been underpinned by a decent amount of continuity in terms of who's been at the helm. So the trust was launched in December 1993, and Evie Hambro has been managing the fund for more than 20 of its 30 plus years in existence. And since 2015, so over the last decade, he's been supported by co-manager Olivia Markham. Now, the Hambro name is one that will be familiar to those with knowledge of the industry. Evie is the eldest son of Peter Hambro, who was the founder and one-time chair of Petropavlovsk, formerly Peter Hambro Mining, and that was a Russian gold miner which actually filed for administration in the fallout from the Ukrainian conflict and Russian sanctions. In terms of what it does or how it approaches investing in the mining sector, it follows a fairly kind of, I guess, fundamentals-based process. So it does a lot of research into the companies it invests in on a kind of bottom-up basis, but it does take note of what's going on in the wider market as well. So the managers take a lot of time. They get boots on the ground. They go actually make visits, obviously, to different developments and projects, and they meet management, and then they do what managers and analysts, financial analysts always do, which is kind of model the companies. In terms of the investment criteria they apply, I mean, it's interesting, when you're talking about a mining sector, the kind of somewhat discredited ESG theme isn't necessarily one that you'd think would be that high up the priority list, but they do look for companies with what they see as quite strong credentials in this area. And having spoken to the managers in the past, it's not necessarily about, not investing in mining companies if they have some issues with ESG, but they see it as being, it's about the kind of the journey. So if the company is on the road to improving, in areas like its environmental impact or its social impact, then that's key. And I think what they really emphasize is governance. They want to know that the company is being well run, because you're not likely to make any progress in terms of environmental and social impact if the governance, if the G bit of the equation isn't there. So they also look a lot at geology because, there's a lot of uncertainty around mining, but they kind of take the view that if the geology's there and the geology works, so if, the companies or the mining companies have got assets which are going to deliver large amounts of metals and minerals, then that kind of compensates them for having to take on some of the risks that are associated with this industry.
Yeah, well, it's kind of renowned for being, well, having a lot of shocks in the industry, isn't it? I guess historically, as you mentioned earlier, with one of the companies. So in terms of the exposures they have, their sort of current positioning, where are they most which metal or type of asset are they most exposed to currently?
Yeah, so we kind of touched on that earlier, and I suppose if we kind of disregard the diversified mining firms, which will be across different metals, although probably with a focus on things like copper and iron ore, given some of the names we talked about there, BHP, Rio Tinto, Anglo American will be quite heavily involved in those areas. I think it is quite striking that 27% has been in gold miners, and they will have benefited obviously from the big surge in gold prices that we've seen both this year but over kind of recent years as well to record levels. It has taken some time for gold producers and gold miners to catch up with the kind of big increase in the gold price, but they are doing that now, and I guess that has probably helped performance and kind of perhaps will continue to do so in the remainder of the year.
Yeah, I guess historically when the gold price wasn't doing much, it was natural to kind of hedge the gold forwards so you don't get that direct or very quick gain from rising gold prices. So I guess the hedging policies are quite key here.
Yeah, that's a fair point.
Yeah. So how big is this trust, and what are the ongoing charges?
Yeah, so it's around about £1 billion in assets, so it's pretty large, and like I said, it's by far by some distance the largest in its kind of niche. The ongoing charges are 0.95%, which is more than perhaps you would see for a more diversified general kind of equity-based trust, but for a more specialist name, it's not completely out of whack with what you would expect. It trades at a discount to net asset value, and a reasonably significant one. It's around roughly the kind of 10% mark, a little bit less than that. But there have been times particularly when the mining sector itself has been more kind of popular with investors, that it's traded at a premium. So it doesn't always trade at a discount. A slight kind of side note there, it's not actually owned by Saba. This is the US hedge fund, which people might well be familiar with, given it attempted to gain control of several investment trusts earlier this year before being rebuffed. But nonetheless, BlackRock and the board of the trust more broadly have entered into a standstill agreement with Saba, which means that Saba won't look to sort of take over the trust in any way until 2027 at least, although it doesn't stop them from buying shares in BlackRock World Mining should they want to. So I mean the discount is sizable, but and it is relevant to say that it has traded at a premium in the not too distant past.
Thanks to Tom Sieber and Martin Gamble for talking about BlackRock World Mining Trust. Now, don't forget, if you'd like us to explore a particular trust on a future episode of the podcast, simply send your request to podcast@ajbell.co.uk.
So we launched this monthly investment trust podcast just over a year ago. One of the key purposes was try to explain some of the complicated stuff that you find in this industry, but trying to put it across in a much more easy to understand manner. So hopefully people who have been tuning into the podcast so far will have enjoyed our education segments. But there is actually one topic which we haven't got round to covering until now.
Yeah, it is a biggie, I think. And to lift the lid on this week's area under the spotlight is Emma Bird, Head of Investment Trust Research at Winterflood. Dan recently caught up with Emma to talk about gearing. So let's hear what she had to say.
So I'm pleased to be joined by Emma Bird, who's Head of Investment Trust Research at Winterflood. So Emma, thanks ever so much for joining us again.
Thank you very much for having me.
Well, we want to talk about the topic of gearing. I think that probably quite a lot of people might have heard the term, but not quite sure what it is. So could you start off by explaining exactly what is gearing with regards to investment trusts and how does it work?
Sure. So gearing is when an investment trust uses debt with the aim of maximizing or enhancing returns. And it's a key advantage of the investment trust structure over open-ended funds, which can't use gearing. So to kind of demonstrate how it enhances returns, as an example, if an investment trust raises say £100 million by the issue of shares, it has £100 million in cash. If they invest that in a portfolio of assets and it goes up by 10% over the next year, then it ends up with £110 million. But if the same investment trust raised £100 million in equity and then borrowed a further £10 million, then you'd say it has gearing of 10% because it's measured as a percentage of net assets. So if it has £100 million in equity plus £10 million in debt, then it can invest £110 million in its portfolio of assets. If that then goes up by 10%, then it ends up with £121 million. It then has to pay back the £10 million of debt, but it's still left with £111 million. So £1 million more than it would have had if it didn't use gearing. So that's how gearing enhances returns for an investment trust. Although investors should be aware that the same dynamic works the other way around as well. So it does also magnify losses if the value of the portfolio falls.
So I presume that just because an investment trust can borrow money doesn't mean to say that they all do. Is there sort of any sort of typical trends you see in the investment trust world? Is it like the majority will have some borrowing at all times?
So different investment trusts use gearing in different ways. The main two ways of using it would be tactical gearing or structural gearing. Tactical gearing is when an investment trust fund manager will actively vary the amount of gearing depending on their outlook. So they'll increase the gearing levels if they expect a strong run in the market and reduce gearing if they think maybe valuations are overdone. Whereas structural gearing is when an investment trust has a general level of gearing that they implement throughout the market cycle, with the idea being that over time, valuations will increase and gearing will enhance returns. But not all investment trusts use gearing at all. Most probably do have the authority to as a key feature of the investment trust structure, but a number have never used gearing. So it really does depend on the investment trust in particular, and also on the type of sector. But we estimate at the moment about 60% of the overall investment trust universe has positive gearing at the moment.
Okay, so I mean, what's the sort of the typical gearing level for a trust you might see, perhaps in a normal market condition?
Yeah, I mean, it really does vary depending on both sector, but also between individual investment trusts. Different managers and strategies have different risk appetites, which will impact the level of gearing that they use. In the equity space, so investment trusts that invest in portfolios of equities, say the typical gearing level in a normal market would be, say, between 5 and 15%, of anywhere up to about 30% could be a normal level of gearing for an equity investment trust. And then on the alternative side, some of those funds will have structurally much higher gearing, particularly if they're investing in large scale physical assets. So things like infrastructure or renewable energy infrastructure funds that need to buy, say, a wind farm that need to use a lot of debt to help fund that, or property funds that are buying office buildings. So the level of gearing there tends to be a lot higher, say around 50% or even higher.
I mean, so if you've got a situation perhaps where a fund manager is sort of quite confident about the outlook, would you expect them to take on more gearing? And then if they're worried, they reduce that gearing? Is it as simple as that? Or do you actually find that some people sort of double down if they think that markets are going to fall? They want to have more money, perhaps, to buy bargains?
Yeah, again, it kind of does depend how tactically the managers use gearing. But in general, if a manager is more optimistic on the outlook, they would tend to increase gearing in anticipation of the market rise or the rise in valuation of their portfolio. But that doesn't necessarily correspond to a general positive market backdrop. So I guess COVID would be quite a good example of where, in general, the environment was very uncertain, and we had a big market sell-off in March 2020, but that led to a lot of attractive stock picking valuation opportunities. So some investment trusts increase gearing levels then to take advantage of these low valuations. So I had a meeting with JP Morgan Global Growth and Income the other week, investment trust that some listeners might be familiar with. They started 2020 with essentially zero gearing. And then after the sell-off in March 2020, they started to increase gearing to take advantage of these opportunities, and had increased gearing to around 7% by the end of February 2021. But then by the end of 2021, valuations, the market had rallied, valuations started to increase, and they'd reduced gearing back to kind of a net cash position by the end of 2021. So yes, I think a lot of managers do vary their gearing levels depending on their market outlook and the market cycle. I'd say that something else to be aware of, though, is that an investment trust could keep the same kind of cash amount, the same monetary amount of gearing. So they continue to have, say, £100 million of gearing invested, but the percentage gearing level will also fluctuate depending on the market moves. So if markets fall or the value of their portfolio falls, their gearing will increase as a percentage of net assets. So it might look like the managers increased or decreased gearing, but it might actually just be a function of the move in the underlying portfolio value.
Okay. I mean, what have you ever sort of come across an investment trust that's got, perhaps on paper looks incredibly high, really high percentage level of gearing here, going, being very brave and going all in, sort of thing?
Yeah, some investment trusts. So if you kind of just filter by the highest level of gearing, some investment trusts do screen as having very high levels of gearing. They tend to be in the alternative asset space. So I think the highest gearing at the moment is for an investment trust called Amadeo Airfort Plus, which owns and leases aeroplanes and has gearing of about 300%, because obviously needs to use a lot of debt in order to fund the acquisitions of the aircraft. And then there's some property and infrastructure funds that have gearing of kind of over 100% as well. On the equity side, the highest geared at the moment is a trust called Premier Miton Global Renewables, which has 49% gearing, and that uses something called zero dividend preference shares in order to gear up the portfolio, or ZDPs, which are shares issued by an investment trust, but essentially act as debt because they aren't entitled to any dividends, as the name suggests, but are entitled to a fixed capital amount at a certain point in the future, similar to a bond. So that's another way that funds use gearing and often lead to a much higher gearing percentage.
Yeah. What have you ever seen a trust get into difficulty because perhaps they borrowed a lot of money, but the market goes into a downturn, and they find themselves in a sort of a tricky situation?
Yes, I think the best example, obviously a long time ago now, but would be the global financial crisis. Before my time, but there were quite a few investment trusts that got into some difficulties during that 2008-2009 period because they had relatively high levels of gearing, and then there was clearly a big market downturn, which exacerbated the problems, as I have highlighted at the beginning, that gearing does exacerbate falls in valuations as well as enhancing returns on the upside. Again, this was particularly felt in alternative asset spaces. There were some issues, particularly in the private equity sector, where a few investment trusts needed to max out their borrowing facilities in order to fund commitments from the underlying funds, private equity funds that they'd committed to. There were property funds that got into some issues as well that had very high gearing. There's one in particular called Invesco Property Income that took on a lot of gearing in 2007 at, I guess, the peak of the market, and their intention was to then subsequently issue shares at a premium to NAV in order to pay down this debt. But then the market went, particularly property market, went into a severe downturn, and they ended up with extremely high gearing levels and weren't able to fund that and to meet shareholder requirements. But I think that there was so many issues during the financial crisis related to gearing that the sector does seem to have learnt its lesson to an extent, and gearing levels across the universe tend to be lower and better structured. More recently than the financial crisis, some listeners may be aware of Woodford Patient Capital Trust, that experienced a range of issues in around 2019. Related to a number of things, particularly their allocation to unquoted assets, and some kind of overlap with the equivalent open-ended fund. But that also had some gearing, and because the underlying portfolio value fell, the trust then ended up exceeding its maximum gearing limit of 20%. This wasn't a breach of investment policy in itself, because they're generally the gearing level is limited at the time of investment or borrowing. But it did mean that the trust then had to request additional flexibility from its lender and implement a kind of clear strategy on how to reduce borrowing in order to get those gearing levels down again.
So, I mean, if someone wants to go and find out how much gearing a particular trust has got, where would they go to get that information?
Yes, so the individual investment trust's own website or fact sheet would be the best place to find that. Generally, investment trusts publish monthly fact sheets, and that should have the net gearing figure on it pretty clearly. The AIC website is also a good place to look. They have a page called Find and Compare Investment Companies, and you can then kind of filter by sector or to look at different gearing levels within a particular peer group, or look at the entire investment trust universe, and you can sort it by gearing if you want to specifically look at investment trusts with zero gearing or particularly high gearing, for example.
Thanks again to Emma Bird from Winterflood. And just as with the deep dives, if you had any requests for us to talk about particular areas of the investment trust world, any educational things that you think you might need to know, then don't be afraid to ask. Just email us with your requests via podcast@ajbell.co.uk.
Right, we've got time for one more guest. I think it's been well known that last October's budget came with some pretty bad news for lots of businesses. As of April, lots of companies are seeing change to employer national insurance hike. And so there's clear impact on their cost structure. So we thought it would be interesting to get a fund manager expert to come on the show, talk through the impact that's had on some of the companies that they've got in their portfolio. So Laith recently caught up with Indri Van Hien, who's co-manager of the Henderson Smaller Companies Trust, to try and get a deeper understanding of this now it's come into force. Here's what she had to say.
Indri, thank you very much for being with us today. I'm just going to start by throwing some numbers at you. So the Smaller Companies Index this year is down 3.1%. The FTSE 100 is up 7.5%. If you look over 3 years, the Smaller Companies Index is up 8%. The FTSE 100 is up 31.5%. And even over 10 years, smaller companies up 65%, FTSE 100 up 84%. What's going on here? Why are large caps outperforming small caps at the moment?
It's a really uplifting start for a small cap.
Sorry about that.
But I think the first thing I want to say is that over the long term, small caps outperform large caps. Since the Deutsche Numis Index started over 70 years ago, they've outperformed the all cap by over 3% per annum compound in that time. So the small cap effect is real and has persisted over the long term. The last 10 years that you've picked up has been actually a really extraordinary time for small caps and an extraordinary time in the UK, because that period picks up the uncertainty into the referendum vote itself, the pandemic, Russia, Ukraine, and the sharp rate cycle which ensued. Small caps underperformed during periods of economic dislocation, and there has been a lot of economic dislocation in this particular 10-year period that you've picked out. I think in essence, what we've seen is rates increasing at the pace that they have put pressure on valuation and earnings, but more importantly, they put pressure on economic growth. And what you get in the small cap space is cyclical exposure. And that is the space that people tend to shun in this time. They try and go towards larger, more liquid, more perceived to be safer assets. And that has really been what has hurt small caps over that 10-year period, and also over the very short term year to date that you have highlighted. Do I see this as persisting? No. I think the long-term drivers of UK small caps are very much intact. Small caps exhibit faster organic growth than large caps. They tend to have higher operating leverage. They tend to be a source of exposure to new technologies and services, and they tend to benefit more from inbound M&A. And for all the reasons that you didn't want to own small caps in these periods of rising rates, if rates start to come down, they're certainly a very interesting asset class to be looking at, especially as at the moment they're trading at a discount to large cap, to trade at a premium.
Okay. And maybe let's zoom in a little bit on more recent performance, because in the half-year results for your trust, you actually say that performance was undermined by Rachel Reeves' budget in October. What issues specifically are you seeing that have dampened performance that were in that budget?
Yeah, so in the first half, the fund really performed well as bond yields fell, as there was optimism around rate cuts, sterling was strengthening, and there was rising consumer and business confidence after Labour's landslide performance. Everybody thought, great, we finally got some stable politics in the UK, small caps can outperform. All these things rolled over into the budget, and then we had the budget itself, which was inflationary but without delivering growth. And that was one of the drivers of these higher bond yields. Of course, Trump's victory had something to do with it. But the UK is a really rate-sensitive economy. And by that, I mean we have way shorter mortgages than countries like Germany or the US. When you buy a house, you take out your 30 or 10-year mortgage. We take out sort of 2 to 5 year mortgages, which means that if rates go up, our mortgages go up, our rent goes up, or in general, discretionary income comes down. And this really put pressure, so that those rising bond yields after the budget really put pressure on our UK domestic exposure in the fund, particularly some of our larger holdings in house builders or building materials companies, or UK domestic companies employing large or part-time low-paid workforces. So it was that really hurt. And it wasn't just, the budget wasn't just damaging for the confidence of corporate investors and corporates, it was also damaging for investors. So many people ploughed into UK equities thinking that stable politics would see the political risk premium erode, the one that sort of widened out post-Brexit. And then we got the budget, which was seen as anti-business, and outflows sort of persisted after that. And the UK small cap market is a very flows-driven market. It doesn't take much to get stocks moving once flows come in. Same on the way out.
So you talked a bit about the kind of macroeconomic conditions and the sentiment created by the budget. What about the actual policy details? So things like national minimum wage going up and also national insurance going up. Are you seeing that feeding through into some companies in the portfolio? I noticed that you've got Mitchell and Butler as the pub group. What are they saying? Are they saying we're going to cut back on staff, or we're going to put up prices? We're just going to have to take a hit to profits. What are they telling you?
So after the budget, the overwhelming feedback we got from all the meetings we had from our corporates were that they were going to increase wages at a lower rate than they had originally planned. So if they were going to give a 5% pay rise, they were only now going to give a 3% pay rise. and then that they were going to find efficiency gains, read job losses, and then finally that they were going to put prices up. And it's worth noting that 2 out of those 3 responses are actually deflationary. If you have more people losing their job, and if you have slower wage inflation, then that is actually deflationary. But the market has chosen to focus in on the last point, which is the putting the prices up, and chosen to see this as inflationary. And of course, there are other factors at play, not just the budget. There's Trump and tariffs and geopolitical risk keeping commodity prices high. But really, that is how companies said that they were going to respond, and the market is waiting to see the impact of the response by companies and corporates in April, before deciding how they see the outlook for UK inflation.
Okay, thank you. And let's just look at the kind of trust performance for a bit, if we can. You're ahead of the benchmark over 10 years, but behind over a 5-year view. Have you identified things that went wrong? Were you in wrong bits of the market that performed well? And have you done anything to change how you go about things?
Yeah, I totally agree. It's been a really disappointing 5 years for performance. But I suppose the first thing to note is that in those 5 years, we actually saw some very strong outperformance in 2020 and 2021. It really all started to unravel in 22 and 23, and our growth bias didn't help in this respect, because as rates rose, there was big pressure on the valuations of the companies in our portfolio. So we saw sharp deratings despite really robust operational performance. And that happened across 22 and 23. And in 24, unfortunately, we had some individual stock issues, which meant we didn't keep up with the rising market. But more importantly, what are we doing to put it right? I think there's just now an acceptance that the direction of interest rates or the path for monetary policy is not so clear cut. There are some really strong cases for why rates should fall precipitously in the UK, but there are also some external impacts that suggest that rates should stay high. And what we've done is sort of tried to add more to our fund. We have a lot of UK rate sensitive exposure, like the house builders that I mentioned, and we've really been trying to add stocks and companies that are going to thrive in a higher for longer environment, companies like XPS that do pension consulting, or companies that just have strong momentum because they have a high market share in their niche and are able to grow outside of trickier market conditions, companies like Alpha Financial Software. So it's really a repositioning and accepting that actually the rate for monetary policy is unclear, and the thing that you can trust and depend on is sort of a strong earnings momentum.
And can we talk about some of the other holdings, new purchases, in fact, in the portfolio? Currys is one I picked out. That's quite an interesting one, I thought, because you think of that as a UK high street name. It feels quite brave to be going into the UK high street at the moment. And on the kind of other side of the seesaw, Raspberry Pi, a technology company, recently floated in the UK. I was interested, did you invest in Float, and do you look at that as an example, a model of a successful technology company in the UK?
Yes, we did. We did invest at IPO, and we're lucky to get a very good allocation. It was what was a very competitive process in that respect. And we have seen that as a success. We have seen that as a good example of strong growth, UK companies wanting to come to market and seeing that as a good place to continue on with their growth path. So we bought Currys actually before the budget, when we saw that high consumer confidence. And of course, UK consumers are still benefiting from real wage growth. And we thought this was a part of the market that was going to benefit, because we're now, 5 years on from the lockdown. So there's a big tech refresh coming. Back in the lockdown, we all bought our new laptops, we all bought our new headsets, cameras for our computers and the like. And that is all needing to be refreshed, and Currys should be a big beneficiary of that. We also bought it for the reinstatement of the dividend. There's been some big balance sheet repair gone on at that company. And finally, we bought it for the very strong trading momentum. UK like-for-likes were running at 5, and forecasts were assuming that Currys would do something closer to 1-2. Given the operational gearing in these types of businesses, as you say, it's a high street business, has very high fixed costs. Any outperformance on the top line drops through very strongly to profits. So we saw a good opportunity. And indeed, they put out a very strong peak trading update after Christmas.
And can we also talk about takeovers, please? Because I think I counted that there've been 4 takeovers in the portfolio in the second half of last year. Is that an unusual number? And does that give us a positive or a negative signal about UK small caps?
No, it's not an unusual number, especially after the Brexit vote. The UK market has been enormously cheap and has remained a favoured hunting ground for overseas and PE investors. I think that this M&A provides a positive signal about UK valuations, which in theory should attract capital to the market. It should lift valuations and encourage more companies to come and list in the UK, thus creating a virtuous circle. It's that second leg that we've been missing. It's the IPOs that we've been missing. And I can understand why growth companies right now are holding off listing in the UK, because they're waiting for those better valuations. But in theory, it is a positive signal for valuations in the UK.
Fantastic stuff. Indri Van Hien, thank you very much for joining us.
Thank you very much.
So that was Indri Van Hien from the Henderson Smaller Companies Trust, and that's all we've got time for today. Thanks very much to all of our guests and to you for listening, and actually potentially for watching. So the eagle eye amongst you might have spotted that we're now publishing content with video and audio. So you can still pick up the AJ Bell Money Markets podcast, the regular weekly one, and these the specials that we do via the normal podcast platforms. But we're also on Spotify and YouTube for video content. So hopefully you'll enjoy whichever way that you're consuming this podcast, and we will catch you on the next one. Thanks very much.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.